excited to have two guests with us from South today, both from the LME and Collins. So, two organisations I had been working with for many years. LME since 1877. But definitely the cult from their inset, who first disrupted the telecommunications industry in voice communication between brokers. So, quick intro today of Joe Root from LME. Joe is the Senior Vice President and Head of Sales in Asia for the LME. Joe Civil Macquarie, and was transferred to Hong Kong in 2006, following Macquarie's acquisition by ING Barings. He then has, within other posts, he has joined the LME initially in Hong Kong, and then moved over to Singapore, where he works very much with the Asian, Pacific, and client base, works very closely with us in capital. So Joe is going to be doing an introduction to the LME guys, and then after that we have Arthur Grant, who has 20 years experience in the capital markets, holding senior sales and leadership roles, and is today the Global Director of Sales, Capital Market Solutions and Agricultural Technology, formerly known as CTO of Telecommunications. So, portfolio which includes exchange, co-location, hosting, managing services, broad localized market data, printers net, which I really don't know what it is, we can explain that later, and ultra-low latency connectivity. So rather than go into detail bio, if you want to explain anything more about yourself, that'd be great when it comes to your presentation. Joe, we're going to quickly off first, as the LME presentation, and look forward to it. Quite excited. Thank you.
My name's Joe. As you may know, I live in Singapore, so I come in, fly out to Dubai for the last 8 years now. So I'm joined here today by the head of sales at LME, Kevin Nutt. So he lives in London. So together we look after our customers out in this Middle East region. We have a quite large mandate to cover Asia, from Japan to Australia, India, and Dubai from the Singapore office. And Kevin heads up the global team, so that's Europe and then North America as well. Today, apologies if you know already a lot about the LME. I'm going to start at the absolute baseline. So I'm going to assume there's a lot of new people to the market. It might be a good refresher for you as well in terms of understanding a little bit the background, the history, why things are the way they are, and hopefully that gives you a perspective on when you trade. It allows you to see the historical context of why the 3-month price is important on the LME. So this is the background on the LME, 1877, so 6 years ago is where we draw the line of when we have historical records of when the LME actually started. But before that, in the 1500s, the LME became a different form. So people used to gather in coffee shops in London to do the physical metals trading. So there was the Royal Exchange, and by royal decree, trading was done out of there. Eventually, people started drawing circles in the dirt, and that was our first open outcry or ring. So then trading became a little bit more formalized, and then standardization of contracts, as we see today. So the initial metals was tin and copper. That is a significant historical context, given that copper was the first, one of the first metals that was dug out of the ground in Chile and shipped into London. And then similarly, tin out of the Malaya, Singapore region was dug out of the ground and then shipped into London. But you may ask, why London? So London was the first centre of the Industrial Revolution. So the world shipped its metal to London through the British Empire, and then it became the first country in the world that went through the Industrial Revolution, and hence, the centre of metals trading centralised in London. And as it developed, you see some historical pictures there, but the standard practices start to emerge, and these practices exist today, and we can see it through what we do in the open outcry, as well as how you trade and the context of that 90-day contract. So 1877, copper and tin. As we progressed through, we added more physical delivered contracts up to NASDAQ, alloy nickel. But the blue boxes is relatively a new concept for us, right? In 2015, we started thinking about how to be more inclusive for our users, right? Because physical delivered contracts are very hard to manage. Quality changes, right? We're fortunate that aluminium, copper, quality is pretty much consistent, but steel has been a big issue where it rusts. The quality does change in a warehouse. So we embarked on a journey similar to other exchanges to look at cash settled contracts. And we'll explain the differences in physical delivered and cash settled contracts over the next few slides. But steel scrap, steel rebar, hot rolled coil, and a suite of electric vehicle type contracts, including lithium, was established, not basis on a price from what we call a price reporting agency. So we constantly review the interest for new contracts, and with cash settled contracts, we're able to launch it a little bit more easier than a physical delivered contract. So we appreciate your feedback. If there are contracts that you think the industry needs, we'd be happy to take that feedback on board. Just some key figures. We do 149 million lots a year last year. So 2023, equal to 3.5 billion tonnes. And notionally, 15 trillion? Multiples of the UK economy. So 600,000 lots per day, if you think about on a lot basis. But not only that, our lots are quite big. So we can potentially do smaller lots, and that will be probably 10 times bigger if we do a 10 times smaller contract, right? So 600,000 lots is a large lot, which is 25 tons in copper, for example. The majority of this business is non-ferrous, so copper, alloy, zinc, lead, tin, nickel. What this demonstrates is, apart from the outlier of that nickel spike in March 22, is it's a volatile market, right? So we are always consistently asked, what is the future price of copper? What do you think aluminium may be? Unfortunately, as an exchange, we can't comment on that from a regulatory point of view. We're the marketplace, so we encourage participants to hedge, right? So I know some people in the room are hedgers, physical participants. You have your trade, and it's important that the hedge is put on. On the other side, the financial participants, the clients who want to get price exposure to copper, you have a view, you want to express it. Why express it through a equity product? Express it directly into the copper product, right? This is the price that's used globally across all the physical supply chains around the world. But the key to this slide is its volatility is here to stay. I don't know what the price is tomorrow. I wish I did. I wouldn't work for the LME if I did. So I would defer to the fact that you need to manage your price risk. You need to hedge as a primary tool. And if you're new to hedging, don't fret, because you'll probably be doing your hedging through other ways already. For example, the FX markets, right? So you're hedging US dollar against the dirham, right? So that's important to understand that hedging on metals is not different to hedging on the FX markets. That is typically the first step for a physical participant. Role of the LME. Why is the LME important? So why do people use the LME? The first one is the reference price. So, like I said, we were the first market to kind of get the industrial metals in, and hence that physical trading started, and hence that history has embedded the LME price in all the physical contracts, right? So from the mine in Australia, where the copper is dug out of the ground, that is basis LME price with a discount, right? Because it's further up the supply chain. So it's important to understand that throughout the whole supply chain, the LME price is embedded in the physical contracts, which gives rise to the fact that you can then manage your price risk, hence the second box. So the price risk management is buying a futures contract. The third piece is you're able to actually take delivery. It's a physical delivered contract on the base metals. Why is that important? It ensures that there is a price convergence between what you have as a forward or futures contract with the physical delivered metal, so that the price does converge at the end. A lot of people, when they trade a market, there's an element of trust. I don't trust that's the copper price. Okay. But then you express your view if you don't trust it. So if you think copper is cheap, you buy it, right? You'll get copper at the end of the day. If you think copper is expensive, you sell it, right? You have to deliver copper. So on that basis, that price convergence guarantees that physical metal is there. It's also a terminal market. So we've become a market of what we call last resort. The market of last resort means that we will accept if it meets our criteria specification. The LME, we have it on our website. We can take in your metal if it meets all our delivery specifications. Okay. A little bit about the contracts. So this is a little bit basic, but contracts are standardized in lots. Contracts are physical or financial settled. We have these prompt dates that go out to daily, up to 90 days. We have a clearinghouse that manages it guarantees every site seller there's a buyer, every buyer there's a seller. Access to the LME is through what we call a category 1, 2, or 4 member predominantly, but there are sub-brokers or FCMs like APM who can give access to the market. This is a little bit technical, I don't want to get bogged down into it, but it's a concept called indirect clearing. So have a chat to myself or APM and we can explain through this. But predominantly, you can go through a category 1, 2, or 4 member or a subset of brokers. So when are the contracts traded? The fees is paid to exchange and then the price is published, right? One lot of copper on the LME. Any guesses how much? How much is one lot of copper? Per ton of copper. How much does it cost? 5 cents, 10 cents, $5?
Fees? You're talking about
Fees, LME fees.
2.7?
Dollars? Cents?
$2.70.
Per lot or per ton? No, so let's talk about on a lot basis first. $3.36
Yes.
per lot, per ton, because every contract is different across markets if you think about it. Every market has different tonnages for their lots. Every ton on the LME for copper is 13 cents. So that puts it in context, right? 13 cents for 1 ton of copper to hedge. This is a little bit difference between physical settlement versus financial settlement. Physical is you deliver, and when you get delivery, you get a piece of paper. It's called a warrant, right? You don't get a 25 tons of copper on your doorstep. You actually get a piece of paper that allows you to then go pick up some copper in a randomly allocated warehouse somewhere within our network. So it's important to understand you get a warrant, okay? Financial settled contracts, so the cash settled contracts are the steel contracts. It's a cash transfer between buyer and seller, basis the reference price. So a little bit about futures. I'm not going to go into too much detail here. forward contracts is technically what we have on the LME. How that's different to futures, a forward contract means that P&L related to that contract is only released at the time of settlement or prompt. Okay, so that forward P&L is locked in until delivery. That's why it's a forward contract. A futures contract, on the other hand, which is more common across many futures markets, other futures markets, is P&L is released daily. So transfers of fund basis what the closing price is, for example, is then sent or requested daily. The LME base metal contracts are forward contracts, technically. Our cash settled contracts are futures contracts. That's the distinction you have to make when you're trading the LME. One is a locked-in forward profit, and one is a daily P&L transfer. Okay, the cash settled, for example, is still contracts. This is just a diagram, very simple, on what happens when you go to physical delivery. The seller sends it to the buyer, the piece of paper, that warrant, and then there's a cash transfer back to the seller. This is a good kind of visual representation when you try to figure out why is the LME so difficult. It's because of this kind of what we call a prompt date. So each of these blue lines at this side of the chart is every day there's a new contract. Every day there's a prompt, right? So you can trade that date next week, for example, next Thursday. You can trade 2 weeks' time. Any day within the first 3 months you can trade. The red line is what we call a third Wednesday contract. The third Wednesday contracts act as more as a monthly style contract. So when you think about monthly style contract, you can think of a copper in August or a aluminium in April, for example. So every month we have one date where most of the open interest sits, and it's always on this third Wednesday, and that's where we call it all the monthly contracts. So essentially, a lot of the users who just want something simple, want to trade a monthly contract, you can trade it, it's there. It's on screen. APM, I'm sure, has that. It's on your screen, you can give it to customers. A lot of financial users are used to trading something simple. Trading a copper in April and then spreading that with a July prompt. So April, July spread, for example, right? So you get that price exposure without having to worry about the daily dates. The daily dates are predominantly mainly physical participants. People who just want to pin their delivery to a specific date. I got my shipment from wherever, India to UAE. I need in 2 weeks' time or in 4 weeks' time, I need to pin that date to the physical delivery. That's available as well. So that's more the physical participant. We could trade out to 10 years. The yellow line is something a little bit more on the edge of our market, which is the monthly average futures contract. So that's the expiry 2 days after the end of the month. So that's the yellow line. So you can get a contract that's the average of the futures market, the average of the daily dates on the LME, and that's the yellow line as well. But if you're a financial user, you're a pro, think about the monthly style contracts. Think of it as similar to any other monthly style contract. If you're a physical participant, it's very important that you understand both monthly and the daily dates. So yes, so this is some jargon on the LME. The LME is full of jargon. It's embedded in the history, so we make it as hard as possible for people to understand. But tomorrow's date is just the TOM. Cash is 2 business days, sometimes called the spot contract. 3 months is what I've just discussed, that if you trade it today, if you long one today, your expiry is 3 months' time. That's a 3 months contract. In fact, it's actually the most liquid contract electronically. So it's a 3 months date, right? You want to get into a position, that 3 months date is historically been referred And again, you think back to the history, it took 3 months to get that shipment from Chile of copper into London. That's why it's a 3 month delay. It took 3 months to get the tin from Malaya into London. Again, it's a 3 month delay. So that is kind of the center of the electronic liquidity. Yeah. So settlement and closing physical delivered positions. So you can close the contract by trading the opposite position. So if you're long, you go short and you flatten the position, but you have to flatten it on the exact day of where you have the open interest. So if you're long one today of 3 months, and then tomorrow you're short one, you are not flat. You have to close today's 3 month contract. Okay, so it's very important. You walk through that detail with your broker to understand where the open positions are to be able to close it. Of course, you can go to physical delivery. I think very small percentage of us want any physical delivery. We just want the price exposure. But there is an opportunity to go physical delivery, but it's a little bit, I'm not sure if you offer it or not. Yeah.
We don't.
You don't, yeah. So yeah, physical delivery.
Let's say a full contract loan.
Exactly, yeah.
Next point.
Yeah, exactly. So it becomes a bit more of a conversation around physical delivery. Usually people close their contract 2 days before expiry, that cash day. Remember that spot or cash day? 2 days before expiry, it's closed. But you can close it up to the day before. So, but before 12:30, it's a kind of cut-off time. But you don't want to risk it. You don't want to get stuck with a physical delivered warrant. So this is on the cash settled side. So it's important that you understand this is just the transfer of cash between buyer and seller, basis the reference price, whatever the index that we use. So again, this is more the steel contracts. So the most active contracts, we have a number of contracts here. The most active is the steel scrap out in Turkey. That's the reference index, the Platts. TSI 8020 CFR, so it's an import price into Turkey. The price has become a bit of a benchmark for the world these days. We are the most active steel market in the world outside of China. We'll go through the volumes a bit later. I think there's a slide with the volumes. But then it's the rebar contract. So Turkey's a little bit special. They take in the world's scrap, a lot of volume on the scrap. They do their magic and they export rebar. So the rebar contract is also the basis Turkey and very, I guess, pertinent for this part of the world. And then we've got the HRC FOB in China. It's a Chinese export price for HRC. HRC means hot rolled coil. Okay, so China is actually the most active steel market in the world, but it's almost impossible for everyone to access. It's a very closed ecosystem. So to access the Chinese market, you need to be have a domestic entity, etc. So if you want your price exposure to steel edge, look at these reference prices, look at these index, and see how it correlates to your physical business. So it's important that you understand correlation to your physical business to be able to use the appropriate contract to hedge. So what does the LME price represent? Why is the LME price important? So it represents, baked into the price, it represents a few things. So one is it's a registered brand. We do a significant piece of work to, when someone makes metal and they want to bring it onto the LME as what we call good delivery brand, similar to the if you're familiar with the gold market, the LBMA good delivery list, we have our own brand registration list. So yes, that's the a hallmark that we've done our due diligence and we've approved it as a good delivery brand. So it meets the specifications chemically of the standards we require. It's stored in what we have an LME approved warehouse system around the world. There's about 450 warehouses globally that we approve that can deliver LME material. The closest one to here, of course, down the road in Jeb Valley. And we consistently put reports into on our website where you can see the volumes across each of the warehouses. It also represents, the price represents a duty unpaid. It's exclusive of taxes, of VAT. So that's quite important, right? Because that is now, it becomes a baseline outside of any tax jurisdiction. So it allows easier comparison. And once you get delivered a warrant, you are then responsible to pay the rent to the warehouse. Or the buyer needs to pay, the person who receives the warrant needs to pay to get that metal out of the warehouse from that. You get given a warrant, and then so you need to take that metal out, you need to take that. You need to pay the warehouse and pay the rent while you're waiting to take that out. This is the supply chain that a lot of people understand through the metals physical market, from the miners to concentrating the metals in a smelter, and then fabricating the cathodes or the ingots for aluminium, and then the consumers. So the LME price is that semi-fabricated place, that blue box there. So that's the price. So the consumers potentially are buying at a premium to the price, and up the supply chain, the miners, the smelters, potentially a discount to the price. So you understand how the LME price fits within the supply chain ecosystem. So the benefits of LME pricing, so it's unique. It's a price set by supply and demand, right? So it's the real physical participants. It's transparent. It's there on screen. We can see it. You go LME.com, go to your aluminium, go to your intraday prices. We have 15-minute delay. It's free on our website. So you can see it. It's transparent to the world. There is a cost to do real-time, to see the real-time pricing, but it's important to actually, when you hedge, lock in your pricing to see what it's trading, because prices can move and you don't want to be out the loop on where the price is when you put your hedge on. Could be the wrong way. It's a regulated market. We're regulated by the FCA in the UK, so the Financial Conduct Authority, on the exchange side, and on the clearinghouse, we're regulated by the Bank of England. So we have a lot of regulation put on us, and it matches the physical market's requirements because it's an exact hedge on your physical contract because it's basis LME price given the historical context. So it's an accurate hedge, not again something that gives rise to what we call basis risk. So it's important when you're hedging to hedge as close as possible to the actual product. And most of the time it is an LME price. So it's robust, there's a daily price, transparent, trusted and regulated. So that's where the LME price sits. This is what the screen looks like. So there's a bid, there's an offer, and then there's a spread between it. So this is quite standard there. AH is high-grade aluminium. And you see the Jan 16, that's a January 3rd Wednesday contract. The Feb, that's a 3rd Wednesday contract as well. The AHD 3 months is today's 3 months price, right? So the 3 months price of today, that contract that expires in 3 months' time. CAD is a couple of contracts. Again, 3rd Wednesdays and 3 months pricing is there. So these are the delivery locations around the world, 450 warehouses across 14 countries. Dubai, we have Jeb Valley, as I mentioned. And this is why we're a global price. Other markets may be specific to China, maybe specific to the US, because their delivery locations are there. This is why the LME price represents a global price, because of the global consistency that you can deliver in any of these warehouses across 32 locations. So why physical delivery, right? So help with convergence between physical and futures. We mentioned that already. Instills credibility, so that price convergence is the right futures price, matches where the market, physical market is. And it's designed to replace physical market supply demand mechanisms. So again, if you feel the market is too cheap, just buy it, right? You're guaranteed to get your metal. This is just a chart of deliveries in and out of the warehousing. It just shows there's a healthy inflow and outflow of metal. So last year, about 2 million tons were delivered in, and then 1.5 million. So what's important in a well-functioning market is people can take their metal out and also deliver in, right? You need to give that facility to users who want the metal. We have a lot of information on our website. I won't go through all this, but essentially a lot of it is where the metal is and how much of a queue there is, and detail about where metal is moving onto the exchange ecosystem on the warrant, or where it's taken out of the exchange ecosystem, where we call off warrant, right? In March, we will start publishing where metal is stored outside the LME ecosystem. So monthly data where you can see that metal can be taken outside the LME ecosystem and put in a shed right next door. That's important, right? Because it's like a dark pool. You're familiar with the equities trading, because what happens is that is a little bit opaque historically, and we're shedding some light into that part of the market. So the metal that is outside the LME market, we're starting to publish some of that data in March. So again, specifically this section will be talking about the trading, the aspects. So we've covered the history, we've covered the basics. Sorry to bore you, but now probably the more interesting pieces around the LME. So 3 venues, specifically the Open Outcry, still in London. If you ever visit London, please come by, have a look at the Open Outcry. It's called the Ring. It used to be someone drew a circle on the ground. Now it's all formal. People have to wear ties. There's no chewing gum. You always have to one leg on the couch. There's no swearing. So it's a little bit stuffy, but it is what it is, right? It's a history. It's part of history, and this is where the official prices are still discovered. So that physical contract that you basis the LME price, LME official prices, is discovered in this Open Outcry, this ring. The other market that is largely traded and brokered 24 hours a day is what we call an inter-office market. It's a phone brokered market. It's a market where broker to broker can trade with each other 24 hours a day, and then put into our matching, our clearing system. As clients, you're probably most familiar with the electronic screen. So how you execute is through the electronic screen. You may bring up the APM screen, you see the LME prices, you're clicking there. That then flows through into our central limit order book, where the whole market interacts electronically. So this is a little screenshot of what it looks like from a member point of view, but your screen may vary depending on what platform you use. You may use a TT screen. So we've got TT reps here today, and they may show you what it looks like there. There's differences between the trading venues, right? There are pros and cons. If you value the personal relationship with your broker, you may want to talk to someone and get some color on the market. You have some structure that requires 2 different legs that's illiquid. You need someone to source liquidity for you. You need to talk to someone more sophisticated that can help put together a structure that works for you on the LME. You can talk to your member or a broker that is good at that. But if you want something simple, you want to get quick, something transparent and easy to trade, the screen is the way to go. And over time, naturally, it's become more and more popular. The screen represents, about 45% of the volume, but that's only going to grow as we move towards more, electronic trading participants, especially this part of the world where everyone's just used to clicking screens, right? So just to get their business done. Our membership, this is the requirements to be a member. So this is kind of not, it's just there for you to understand what the requirements and what the capabilities across our membership are. These are the contracts for the base metals. So lot size 25, one lot, 336, which is about 13 cents, so 13 cents per lot. 336 divided by 25 is about 13.44 cents per lot for copper, aluminium, etc. These are the codes. If you have other market data platforms, you want to look at, or you have Refinitiv or Bloomberg, these are the codes for the monthlies and spreads between each of the contracts. These are the volumes. So volumes have significantly had a big boost in December last year. January is performance even better. So most of the volume is on aluminium, then copper, zinc, and then lead, nickel, tin. So we see last year average was 600,000 lots a day. December's hit 700,000 lots. I think January is already about 700,000 lots as well. So we're getting more and more growth and traction. So, but this is the relative spread between the volumes across each of the metals. The steel contracts. We have these 5 steel contracts I mentioned already. Cash settled futures. They're very, in terms of exchange fee, they're 3 cents a ton, 30 cents a lot. Relatively insignificant in the scheme of things. So that's because we want to encourage more adoption, more growth in these steel contracts. Scrap, Turkey, rebar Turkey, hot rolled coal China. There's an Indian scrap and a Taiwanese scrap. That is the order of liquidity. Most of the volume is actually the blue line in the Turkish scrap. So the Turkish scrap is predominantly most of the volume, but then there's some rebar volume as well. So we're up about 65% year on year. So it's been a spectacular year last year on steel, and 9 million lots were traded. So that's 9 million tons were traded. So 900,000 lots. So that's quite a large number where you can find liquidity if you need to trade it. So 9 million tons were traded last year. This is just a little bit of a recap on understanding the financial users and the physical users. So on the right-hand side, you've got the physical users, that daily date. It's very important. It's the core liquidity on screen. And then on the other side, you got the financial users. You got the monthly contracts. You just want to get a copper in August exposure. That's what the financial users want. So there is a bridge between both user bases, and that's that 3-month to third Wednesday spread. That's available and tradable on screen as well. So this next section will be more kind of important for the proprietary or the speculative users of the market. It's very important to understand this relationship between the 3-month, the monthly, and the 3-month third Wednesday spread. Or when we call on monthly, we sometimes call it a third Wednesday. So in your mind, interchangeably, a monthly contract is also a third Wednesday. This is, again, LME jargon we need to contend with. On the physical side, you can trade any date to any date. So that's the 3 months to any other carrying date. That's important to the physical market. That will remain and is often used as people go to delivery on different dates. And then there's the Tom-Next contract, where as you approach delivery, you want to delay delivery for a day, you do a Tom-Next roll. So that pushes the delivery date 1 day out at a time. So that's what we call the Tom-Next carry. On the financial user side, that monthly contract, again, there's also a month-to-month spread, otherwise known as a calendar spread, right? So that's what a lot of financial users are used to, understanding this calendar spread between July copper to August copper. I want to transfer my position. That exists as well. So the only thing that I want to leave you with today is understanding this. But not only this, only the top 3 boxes, the 3 month, the monthly, and the 3 month third Wednesday spread between that. That's going to be 99% of understanding the LME. So once you kind of get your head around the monthly, the daily, 3 month, and then the spread, what we do on our side, we imply the prices. So you look on this side, on the implied pricing side, the 3 month price is a certain bid-ask spread Y, 50 cents. There's a spread between that contract, right? The 3 months to September 17th price. That has a certain bid-ask spread, that's 10 cents Y, right? So then together, that is joined together to create a monthly contract that is implied from the spread between 3 months to Wednesday and the 3 months price. So that outright is that monthly contract. It's a little bit difficult to digest, and it may take time to understand, but this is quite a fundamental part of the market to understand this implied pricing. It means that if you trade the 3 months, or you trade the 3 months third Wednesday spread, that contributes to a monthly contract. Who wants to trade a monthly contract? People who just want a simple exposure to the LME, they just want to trade a copper in September. But if you're a little bit more sophisticated, you can quote that spread, the 3 month third Wednesday spread, and be able to help accumulate liquidity so that when you get filled on the spread, when someone hits the third Wednesday, that monthly contract, you will automatically get filled on the 3 month third Wednesday spread. Okay? So you get hit on, someone lifts the monthly contract, the 3 month third Wednesday spread gets filled, and whoever's on the 3 months will get filled. This is just a worked example on what it looks like on screen. Again, the 3 month is the AHD3M. There's a price there. There's a spread between that 3 month third Wednesday. That's the second row. And then it creates that third Wednesday price. Okay, together, it's implied together. Some users just want to trade a monthly contract. So trading the monthly directly here on the left-hand side is, you can be long third Wednesday contracts, you can be long 10 today and you're short 10 tomorrow, you are flat, it's the same contract. On the right-hand side, you've got the monthly contract, the 3 month contract. So you can be long 20 and you're short 19 today. You are one lot long that you need to worry about and close out before the end of the day. Otherwise, you have exposure and it can be difficult to source liquidity to get out or expensive. So you need to have that in mind and understand that if you're long one today and you're short one 3 months tomorrow, you are not flat. Okay? You have that 1 day exposure when you're trading LME. This is probably the most common caveat when people come to me and say, hey, I'm trading this 3 months, why can't I get out? Where's the liquidity? It's because the 3 months changes every day. It's not the same contract every day. So it's important that you understand that the 3 months contract, long one today, short one tomorrow, you are not flat. But if you're long one third Wednesday today and short one tomorrow, you are flat. Okay? The mechanics of that is very important for you to trade.
What is the carry cost for 3 months?
What is the carry cost for 3 months from
Short position or long position? How much is the spread? In case if I short, how much I will get the percentage wise?
percentage-wise in your account?
So if I do spot,
Yeah.
my carry cost is 5.01%,
Okay.
which is in mid.
No, which is the rate, the interest rates.
Yes.
Yeah.
The same with LME, like we do here.
If it's a contango market, is a 3 month. There's a spread between 3 months.
Like all the market is in backwardation.
Then it's the opposite. Yeah. So there is a contango backwardation price. If you want to carry a price into 3 months time, that can be traded on screen. No problem. And that's transparent. No issues there. Okay, so important to understand that the daily 3 month price and the monthly price. Please ask questions if you don't understand this. Now, if you're a prop, you can probably look at this and take advantage or think about this more broadly in terms of how you can take advantage of the market structure, why this market structure exists, and how you can take advantage of it. So this is an interesting chart because it gives you a lot of information on when the 3 month Wednesday spread is traded. It's mostly in the London afternoon. 4 p.m. London, it's the most liquid, right? So for historical reasons. In the Dubai time, in the Asian time, it's not so liquid. So it's important to understand where you can trade out of a contract, the 3 month Wednesday spread, 4 p.m. London time, and where you can accumulate risk potentially wider in the Asian time. Okay, accumulate risk wide in the Asian time, less liquid, get out in the London time. That's something that some participants employ, right? So this is specifically some analysis that we've done, and I highly recommend you, if you're a proprietary trader, to go away and do your own analysis and think of the market structure as I've just described. The dotted line is the 1 a.m., 8 a.m. London time. 1 a.m., 8 a.m. London time, it's wide, right? The solid line is the 4 p.m. London time, bid-ask, okay? So wide in Asian time, tight in London time. Some users accumulate risk wide and get out when it's tight. That's something that's traded commonly. So it's not going to be always the 4 p.m. London time. It's within the Asian time. Sometimes actually outside. It's not, there's no 100% in anything on the market. Sometimes it is outside the Asian time. So it's important to kind of get a feel where the market's trading. But this is some ideas and some analysis that we've done. Around 67% of the time, that 4 p.m. London price is within the Asian price, 1 a.m. to 8 a.m. London time. Okay, 67% of the time, or about 2 standard deviations. And you can see as people participate in that trade more, what happens to the monthly bid-ask spread. Remember, we learned a few concepts. The 3 months is already liquid. Someone quotes the 3 month Wednesday spread, that 3 month Wednesday spread, and then that creates the monthly contract. That was the implied section. As people do that quoting, the monthly contract becomes tighter, doesn't it? The bid-ask spread, as more people participate, the bid-ask spread becomes tighter. So if you look at the copper M2, conversations were being had with participants last year, and then eventually the bid-ask spread is slowly dropping. So on the monthly contract. And that's useful because all of a sudden you can then participate directly onto the monthly contract because it becomes more competitive as the 3 month contract, the daily contract. That's the yellow dotted line. That 3 month contract is always going to be the most liquid, it still is. But gradually the monthly contract is dropping. So the bid-ask spread on that's dropping. So participation on that will only grow. And we can see that in some quarterly reports that we send out to customers. So the fact that we have an implied market, the fact that we have a daily date, the fact that we have a spread between the daily and the monthly date, all this kind of uniqueness about the LME has allowed some participants to take advantage and help build liquidity because people are accumulating risk wide and then trying to get out in the London time zone time. Right? Some incentive programs from us. If you are a proprietary trader, you can apply for these incentive programs. So 1/3 of the fees is discounted for passive volume. So passive is a limit order in an order book, resting order, so you get 1/3 of the fees off. And then if you're day trading, if you're trading in and out within a day, another 1/3 of the fees off. So your $3.36 all of a sudden becomes $1.12. Okay, so that's your trading for one outright fee. So have a chat to me if you're in this camp, if you're a proprietary trader. And we have pretty strict definitions of what a proprietary trader is. So professional trading on their own account, on their own money. If you're a hedge fund and you take client money, we have a program for this as well. But it's mainly based on volume. So the more you do, the more discount you can expect from this incentive program. So we call it the electronic volume program. The thresholds are, 500 to 2,000, and then 2,000 above if you're just on this program. Again, have a chat to go through the details. And if you have the capacity to quote, if you can market make, if you put two-way prices on screen, those 5 steel contracts, we have a stipend pool of about $85,000 for people to market make and quote the steel contracts across those 5 steel contracts, 9 hours a day. So if you have that capacity to quote, this incentive program is available as well. So again, there's a lot of detail around this, around what size, how many contracts, etc. So happy to walk you through it. Okay, that's the end of my presentation. Thank you very much. I hope it wasn't too laborious and interesting, and I hope we can have a wider conversation after this. But any questions, that's my contact details. And I guess I'll pass it over to Arthur. Okay.
So, good afternoon, everyone. My name is Arthur Rank. I'm the Global Director of Capital Market Solutions at Colt. Firstly, thank you to Nick and the APM Capital team for inviting us along today and giving us an opportunity to present and speak to you. And thanks, Joe, for that really interesting presentation, specifically on the LME, who are a really big and critical partners of Colt within our ecosystem. So, for those of you who don't know Colt, as Nick alluded to, we were founded under the full name of City of London Telecommunications by Fidelity Investments in 1992. And that was in direct response to kind of the Big Bang in the City of London, where connectivity, communications were becoming more reliant on electronic volumes, and Fidelity saw an opportunity to build a company which directly responded to that. So whilst Colt was founded as a provider within the City of London, as the electronification of markets and trading spread globally, Colt has built out a global network to respond to that. So today we have a really significant footprint of over 31,000 on-net buildings. We have around 180,000 kilometres of Colt-owned and delivered fibre globally. The core network, original network, was built out across Europe, and really what the driver for network expansion for Colt has always been into critical financial centres. Whilst we cover enterprise and wholesale telecommunications as well, our expansion has always been driven by the need for capital markets to connect, and then other enterprise, other services really follow that underlying network. We expanded into Asia with the acquisition of our sister company, a company called KVH, which was an Asian telecoms provider in 2015. That gave us that footprint which expanded from Europe into Asia Pacific. And then we also expanded our global network to cover a US ring covering 12 major North American cities in 2016. And the Colt network goes by the term IQ network, it's an intelligence network, and that underpins everything we do in capital markets. And it's really the need to connect and communicate, and to connect and allow the world to communicate more effectively that we're looking to change. Also, there was another procurement made by Colt in 2011 where the company acquired a smaller, more niche provider in the markets called Market Prism. And Market Prism was focused on ultra latency and co-location services. So it was a much smaller organisation, but combining Colt's global network and Market Prism's speciality in low latency, we really delivered a go-to-market strategy for capital markets specifically. So we've always had it at our core, but then have a lot more focus on low latency trading and market data. And I'll come on to that in a second. So again, we are built for capital markets and to deliver that on an expanding basis. So we've been present for over 30 years. We're still wholly owned by Fidelity. We continue to invest in us in terms of network expansion and purchases of other companies. We've got an ecosystem which we've built for capital markets, and I'll come on to that in a bit more detail. And again, we're always looking to grow that ecosystem, bring new participants on board, and add value to those existing participants, and add more services to be able to service the capital markets community. And whilst we're a telco, we have over 6,000 staff now. We still operate a direct line of business specifically related to capital markets. So prop trading firms, high frequency trading firms, prime brokers, brokerage houses, exchanges all sit under a dedicated go-to-market vertical within capital markets. So that means you have a dedicated capital markets account manager. Specialist sales team work specifically on propositions around co-location, low latency market data to support that. We also have a dedicated service delivery team and engineering team that supports our portfolio within capital markets, and then also a dedicated 24/7 capital market service desk, which sits within our standard service organisation, but it specifically supports our capital market solutions proposition. So if we look at our portfolio, I'm going to go into each of these in a little bit more detail in a minute. So we have our dedicated connectivity, so that would be typical Ethernet and optical services, IP access, and also our voice services, which sits as a complementary service. We have our financial extranet called PrismNet, which is an ecosystem for providers and consumers of content to connect more effectively and easily globally. We have our ultra low latency offering, which is essentially the fastest available fibre routes that Colt can build between critical exchange locations. So maybe connecting Basildon and ICE to Frankfurt FR2 for consumers who need to pass data quickly between key execution venues where they're co-located. And we have an ultra low latency offering across Europe, Asia Pacific, transatlantically and trans-Pacifically to connect that offering. We also offer hosting services within co-location and proximity sites, and then we have a broader market data offering of raw and normalised market data solutions, which I'll provide some more information on in a second. So for those of you who maybe don't use extranet services today, what is an extranet? Fundamentally, it's a managed layer 3 network which enables the easy connectivity of providers of services, such as exchanges like LME, London Stock Exchange, Deutsche Börse, to consumers of those services, anyone who wants to trade on those markets. We also have a range of other service providers on the ecosystem, so prime brokerages, FX ECNs, fixed income trading platforms like Tradeweb, Market Access, market data vendors distribute market data across our extranet. And so fundamentally what we can do is bring that world of services into your environment in a simple and effective way. So how do we do that? You could be located in an office, in a data center, in one of our PrismNet POPs, and we can connect you resiliently via a pair of cross connects or fiber circuits into those locations. Now from that access, what we can then do is logically enable logical services, so to trade LME select, CME products on Globex into that location without having to build what we look at as basically a spaghetti bowl of connectivity, which is complex to manage and has specific requirements, particularly for exchange trading. And I think a really good example of this is if you look at European markets, if you want to trade the largest markets in Europe and you want to build that in-house, that will require a network team. And that network team will have to meet the connectivity requirements of each exchange. So what that will do is you'll have to build a completely resilient, no single point of failure paths to connect to the A and the B feeds for that market. Any single points of failure means you could be taken out of the market if there's a loss on the A service. You then also have to build a third piece of connectivity into the DR side. So for each of these markets, you need 3 completely resilient services from the point of ingress into your environment to the point of ingress from the exchanges. And it becomes, when you look at that, multiple markets, geographically, a big spaghetti bowl, which is hard and complicated to manage, and you're taking that risk in-house. So by outsourcing that connectivity to a provider and a partner like Colt, we manage that network completely. We build it out on low latency routes. We completely manage the failover from the A and B. And if there was an unfortunate event of a complete loss of an exchange's primary site, we'll automatically follow their protocol to fail over to the DR site. That's all built into our relationships with those exchanges. So we de-risk your trading infrastructure. In terms of our global network, we're located and we have points of presence in all the major trading metropolises. These are always built out as resilient points of presence as well. So if a primary POP goes down, we have a secondary point of presence in that location. So our connectivity to you remains uninterrupted and you have continuous access to market. As I mentioned, we're always looking at expanding into new areas. So some of the more recent additions to our network include Sao Paulo for the B3 exchange. Last year we went in and connected into Bursa Malaysia, but we're also bringing other providers into our ecosystem in other locations, non-traditional markets. So if you look at the growth of crypto trading, we have on-ramps into AWS zones globally or into GCP and Azure, wherever crypto firms and market makers are propping up and exchanges. We're there, we can provide that connectivity off the back of our IQ network and connect that into PrismNet for a fast and easy access. At the moment, this is a really exciting area for us in terms of the Middle East. We're seeing a lot of connectivity demands to come into Dubai. From our perspective, it's a relatively new area to start speaking to local firms within Dubai who are looking for connectivity outwards. Hence our presence here today. But again, where we see customer demand, we can extend our network locally to bring new consumers on board to access our ecosystem of services, and new providers, new exchanges to connect and offer their services to our global ecosystem. So today we've got over 80 market data feeds available. This is in addition to all the brokerage and ECN services. So we cover the majority of all the major markets across Europe and Asia Pacific. We also in the Americas cover CME and B3. We're not so strong on US equities, a very, very crowded and expensive market to do. And where we've kind of built this ecosystem out from, we are market leaders in Asia Pacific. To give you an example there, 80% approximately of volume executed on JPX either comes from Colt hosted and managed customers or Colt customers who are connected via our infrastructure into JPX. And there's similar numbers around Hong Kong as well, where we're founding partners and we're in terms of their technology, hosting and connectivity services. In terms of that market data, all markets we deliver in the raw format. So if you want to normalize those and consolidate multiple feeds via your own APIs, they're all available in raw format. And across Asia Pacific, we also do act as a market data vendor of record and normalize those services into a light touch multicast API for customers who need to follow more of a brokerage model across Asia Pacific. On top of the market data and PrismNet backbone connectivity, we also offer a fully comprehensive hosting and managed service as well. So Here we've got presence in all the major commodities, derivatives, equities, co-location and proximity facilities. So where there is an exchange colo, we'll have points of presence and can offer managed services. So space, power, dedicated or split rack services, rack stack and configure, smart hands management of those environments as well. And then obviously the connectivity into the market for the supply of market data and execution order flow. And then the value-added service of back-end connectivity to any locations you need to access that, and IP access for command and control of your trading environments within them. And again, this list isn't finite. We're always looking to expand into new co-locations and new areas where we see customer demand or exchanges opening up those locations. And Colt continues to innovate. You know, if we were just a network infrastructure provider, that becomes a finite business. It's a competitive market. So how do we differentiate? One of our big product launches last year was was the launch of our cloud multicast service. So as we've seen a demand for customers moving into new markets, there's been more demand to use local cloud provider services as a means of access to get into new markets in Asia or Europe, as a really good example. If you look at the barriers to entry in terms of cost of accessing new markets, they can be considerable, and there's no guarantee of returns. So one of the user cases we've seen for this, and where this is innovative, I should say first off, is if you look at cloud technology, a barrier to capital markets firms and trading firms using more cloud adoption is the restrictions around taking and broadcasting multicast data in those environments. Essentially, if you wanted to connect a live market feed via multicast into an AWS environment previously, you couldn't do it. There was not the technology in place. What you'd have to do is pay for on-prem facilities, take that feed into a ticker plant, normalize it into a unicast format to pump into an environment with AWS. So there's a duplication of costs, and you take away that advantage of the flexibility that doing business development and testing and production trading in the cloud gives you. With our proprietary technology, which we developed in partnership with AWS, we use some proprietary software which is built into our cloud VPNs, which allows us to process those market data feeds that we have already sitting on our backbone in their native format and process multiple markets. We ran the proof of concept on this across about 12 markets in Asia, in real time, in multicast mode, into a client's environment. We're pushing those data volumes up to about 2 gig of data consistently, and we used our proprietary multicast monitoring tool to ensure the data quality of that. And really, we were happy after that with AWS to make a go-to-market announcement. We have a number of customers who are looking at this now, and a few who are using it. A really good example of this technology is we did some press last year with AsianX, which is the first digital assets exchange in Asia. They went live in September, October, I think it was, Russ. And they use this technology to, their exchange system is sitting within AWS in Singapore, and they use this technology to broadcast multicast data out to their non-AWS based market participants and members. So it's proven technology, and it's now live in the market and fully monitored and managed. And so fundamentally what that does is extends Prism Next reach, extends our market data reach from on-prem to cloud now. And it's a true first in terms of the market. And how would it apply to market participants? Well, if you wanted to test the market, really do conformance testing, and have a commitment to maybe going into co-location eventually, but don't want to put physical infrastructure in place to test your strategies for low latency, this really allows you to do that. We can get these environments spun up within 5 days after contracting. There's the flexibility of doing that. If you look at a physical delivery and colo setup, with certain supply chain issues as well. I know that's getting better now, but you could be looking between 9 months and a year to have any infrastructure in place within a co-location to start even testing that market with no guarantees of return. So a lot of our colo customers are looking at this as a route to market to do their conformance and market testing before moving into a fully managed co-location environment. So really brings that time to market down and allows us to be more responsive to our customers' needs. And it's great that LME are here so we can bring those services, that infrastructure service story, into a real life example. So we've had a long-standing relationship with LME. You know, we underpin fundamentally in a big way the LME Select trading service. So, and it's a range of services that we offer for LME. So, as part of the managed service LME net for LME Select, Colt manages and delivers that underlying network. We have a dedicated service management team. We work in close partnership to onboard and manage those LME net customers for LME Select trading as well. Outside of that, we also offer services as a network service provider and a vendor of record. So you can connect to LME via PrismNet today, so you can connect to LME and multiple other commodities markets via one single point of access. And also, LME is one of the exceptions to the rule in terms of normalised market data. We're also a vendor of record, so we can provide the LME market data in either its raw format or our normalised format as well. So there's a range of options there. We can also offer co-location and proximity hosting to LME. One of our proximity sites is Interaction. We also have hosting available in Slough, so for both primary and backup DCs of LME, we can be as close to the matching engines as possible there. And then again, if you didn't have that, weren't so latency sensitive to need to be in colo or proximity, we can deliver those markets as away markets on PrismNet as part of that managed service. Also on top of that, if there's any dedicated point-to-point connectivity via Ethernet or optical services, we can also deliver that within our standard portfolio. So fundamentally, however you would want to connect to LME today, either it's the most latency sensitive consumption of market data, away market trading, or on dedicated connectivity, we supply the full range of those services. And another driver for us being here today is due to a major acquisition that Colt made in October last year. So Colt took a $1.8 billion acquisition of Lumen's EMEA business. So we have taken on board all their physical assets, networks, data centers, managed services, and all Lumen EMEA all Lumen EMEA staff. So for the capital market space, the really exciting thing that brings to the table is that extends the Colt network's reach into the Middle East, also down into Africa, into Nigeria, and more predominantly South Africa for us. So it really brings an expansion of Colt's network outside its traditional network into this region. And that brings the opportunity for local participants to be able to access the Colt network to access markets outside of this region if you're looking for expansion beyond the local markets. So I won't keep you any longer. I really appreciate everyone's attention. If you have any questions, I'm happy to answer them now. I'm also here with my colleague Russell Toop, who manages the capital markets specialist team in Asia Pacific and has a lot of specific market knowledge there. Happy to answer anything now, or we can network and have catch up outside. But any questions that I might answer for you while I'm up? No? Okay. Well, thank you very much for your attention. Really appreciate it, and hopefully we'll get to catch up outside as well. But thank you so much.
Thank you everybody so much. Thank you so much, Arthur. Thank you, Joe. Anybody who would like to copy the presentation packs, we're happy. Come to us, Hitachi, Maria. We're happy to provide those for you. I hope this has been educational. I hope you will take pleasure in it. If anybody has questions about the LME when Joe is not here, come to me, because I do actually have 38 years working with the LME. if anybody's got technology questions, don't come to me. Because I would have to go to Arthur because I don't understand it all. Even though I have worked with you since 1992. So thank you so much. We will do another good, come outside, have a drink, have a cup of coffee, have a cup of tea. More than welcome if you've got questions for these guys. But most of all, thank you all of you so much for coming on today. It's been an absolute pleasure to see you all, and I hope you've enjoyed it. Thank you so much.